China's best-selling car maker announced price cuts of up to 35% last week on its electric and plug-in hybrid cars. BYD has attempted to clear inventory of its older models in recent months, but the newly announced price cuts are also reflecting sluggish consumer demand in the world's second-largest economy. Meanwhile, BYD sold more electric cars here in Europe than Tesla last month, marking the first time that the Chinese EV maker overtook its key rival in the bloc. According to data out of Jato Dynamics, BYD registered over 7,200 fully electric cars in Europe in April, a near 170% jump year over year. Let's get to Yuqian Ding, who is the head of China Auto Research at HSBC. Thank you so much for joining us today. Can you just draw out the links between the Chinese market and having a dominant position there versus selling in Europe? Because it feels as though BYD is facing pressure at home, but it is still a game of volume in that domestic market as it also bolsters its ambitions to target more product here in the European markets.
Yeah, sure. There's really two sides of the debate. In domestic China, I would say the lukewarm overall market demand and also aggressive BYD's sales volume target, coupled with we are right in the process of industry consolidation, which makes a price cut or the pricing universal pricing pressure temporarily part of life now. We are yet to reach the inflection point of China consolidation. So we do see OEMs such as BYD prioritize market share and volume in the near term than the margin and profitability. So I would say I would clarify a little bit. The price cut is basically a repackaging of the discount in the channel coupled with the national EV subsidy, which means all the EVs can get that. Sometimes the OEM repackaging the central government, local government, as well as the channel and their own subsidy together as a marketing tool to attract traffic into the channel. So all in all, I wouldn't say the discount just appeared last week. It's a repackage of the existing discount. Although the muted growth of the overall market and also the strong ambition on the market share probably push up marginally the OEM's discount a little bit higher, but that's the chapter we're currently going through in the China domestic market. On the other hand, overseas, I would say BYD's EV battery as well as the autonomous driving push make their product globally competitive. So we do see globally, not just in Europe, BYD is also gaining strong traction in ASEAN, in South America. So leveraging the strong product competitiveness and expanding channel, they are making real progress. But they do view European as a strategically important market. They are building the plant over there in both Hungary and Turkey. Hopefully the deep localization will help them to mitigate the potential trade risk into mid to long run. So they're on good track and they're happy with it. The overseas market, because of the competition level is lower than the China domestic market, do came in at higher margin, which support their continuous consolidation push among the domestic market.
I think what jumps out to me is that we've got automakers in Europe that are facing multiple threats. You mentioned the tariff impact that's certainly there in terms of what it's going to do for selling some of these goods into international markets. Of course, the threat of what it could do to consumers. But then China was the cash cow for a lot of these automakers that are facing such a big domestic threat now from these Chinese players. What happens from here in terms of the European markets and who conquers all? Because it used to be the big German automakers. How much disruption are you now seeing in the European space, and will price be a major factor for who claims market share in Europe?
Yeah, great question. I would say domestic in China, especially the EV competition, we've seen the competition bar has been raised since BYD is introducing autonomous driving into the mass market. So it's really the smart EV is the game changer if you want to compete EV in China. So I would say it's largely a product cycle thing. And we do see in this year's Shanghai Auto Show just last month, generally the international brand, including the German OEMs, are demonstrating their new EV model models in China. They are strongly locally committed. We do see they're leveraging the local supply chain to launch the product with high level of autonomy. And BMW and Volkswagen going to introduce 3 new EVs next year. They all look like highly competitive, even against the local context. So I would say these international brands are struggling in China, and the new product cycle might help them to regain certain market share back and provide more relevance in the China market. But still, it remains extremely challenging, and it's not just the EV competition, it's the smart EV competition. You're not going to get the robust range and charging ready. You're also going to load pretty advanced digital experience into the vehicle to have your brand stay relevant in China market. So I would say as long as they get the product cycle right, as long as they get the smart EV right, they will stay relevant in the China market. But still, on the pricing side, since BYD and other local brands are pushing hard on aggressive pricing front, the international brand might have to sacrifice a certain level of profitability to sustain the volume traction.